All right, episode 9 on the More Doors podcast. We're going to break down what's more beneficial for you. Is it cash flow or equity? We're going to get started right now. All right, welcome back to the More Doors podcast. We're breaking down in today's episode. Should you be looking for when you invest in a deal, when you buy an asset, should you be going for equity? Should you be going for cash flow? Is one more important than the other? So I'm joined with Matt and Brian today, like always, and we've got some good opinions on this. But before we get started on that, you need to go listen to last week's episode 8. That was a great one with Tony. He shared some amazing information. It was jam-packed full, and he's got a great offer for all of our listeners. So go reach out to Tony, as well as go to our sponsor's website, Deep Blue Capital. Go to deepbluere.com, and when you go there, sign up for the newsletter. Make sure just to look around and see. Maybe you're interested in seeing what it looks like to invest in a syndication project that Deep Blue's doing. Maybe you want to see their past performances or what they've got going on, or just seeing what's going on in the marketplace. Just sign up, and you can request a free consultation from there. So go to our partners, deepbluere.com. So, all right, guys, cash flow versus equity.
Yeah.
Some would say that probably you should go for both.
Mm-hmm.
But is one more important than the other? You know, as we were kind of preparing for today's show, Matt, you brought up something, about what should we look for when it comes to the equity, or should we talk about taxes, everyone's favorite word?
Yeah.
And is that going to play an important part? And I think it definitely does. So, when you're breaking down a deal, some deals have, a great monthly, cash flow on it. It pays out a great, whether it's monthly or quarterly, it pays great percentage on to your investors or to the owner themselves. And then some may not be heavily, cash flow, intensive, but it's a great equity play. It's a great exit strategy. And so what do you prefer, Matt? And then I'll go with you, Brian.
My answer is it depends on the opportunity, right? Would I love to have excellent cash flow and then a big potential exit in a property? Absolutely, right? But not all deals are created equal, and I think this kind of comes back to the buy box conversation we had a few weeks ago, where you got to be looking and targeting deals that fit your investment criteria. I like a blend, to be honest, right? I have certain deals that sat and needed to get turned around for 12 to 18 months before they started to pay dividends. And then they were paying nice dividends, but there's a refi opportunity or a big exit opportunity because we drove so much upside value in those deals. And there's some deals that I'm okay with no cash flow at all because the exit's going to be very, very attractive even under conservative underwriting. So I tend to look at both of those types of opportunities because they both fit my investment criteria, but not everybody's created the same.
Yeah, 100%. I couldn't agree more. And I think that's, it's like looking at when you're investing, you're building a portfolio just like anything else. So stocks are the easiest sort of analogy to use here. You shouldn't, if you're investing in the stock market and you're actually going to pick individual stocks, not just like invest in ETFs or something like that, you are wise to have a balanced portfolio, right? Some value stocks, some growth stocks, some dividend paying stocks, because at any time, the last 18 to 24 months has been a great example in the American economy, right? Things fluctuate, and there are going to be some asset classes or some sectors that do better than others, and your goal as an investor is to make consistent returns over time. And so, it's important to be diversified for a couple of reasons. Not only does that hedge your bets and your risk, it also it evens out your long-term goals, right? Because if you do too many deals, we talked about this in our first meeting as when we were becoming business partners, right? If you do too many deals of one particular type, then your time horizon is very limited to that extreme. Meaning if you do just deals that are basically going to be future equity plays, well, your cash outlay is going to be really substantial for a very long time. Like, you're going to be wealthy on paper and maybe eventually broke in real life until 5 years from now, And
like, man, I'm so rich on paper.
Yeah, exactly. But, you can't afford coffee, but in 5 years it's on you.
Yes.
Or you can have only cash flow, which is amazing. And a lot of times the deals that cash flow the best don't have the most long-term appreciation. And sometimes you hit home runs and you get both. But I think it's really important to just take stock of every single deal and go, how does this fit into my larger goals? Am I too equity heavy right now? Do I need to build a bigger cash flow base? Or am I cash flowing really well right now, but when we get to the dispo on these assets, I'm basically going to be starting back at square one because I'm not making really any sales proceeds.
No, I think that's a great point.
Yeah.
And I agree, and I think probably most would agree with this, is being diversified in that. And I've seen a lot of investors in the way we built our business as well. It was always kicking the can down the road. It was always equity, always putting back in. We never took out, or we took very, very little. And, it did pay off in the end, but there are times that I look at it as like, man, we've kicked that can so far down the road that then we start running into economic issues that you can't forecast. Yeah. And if you're just always building it based on that, and then it all goes sideways, well, now you've just burned up a lot of your cash. Mm-hmm. You've burned up you're probably stressed out and mentally fatigued. And you probably now become gun shy of doing any future deals. And you don't want to look at it because you're like, it just doesn't work for me.
Yeah.
And I've seen people that's happened to, where it's that delayed gratification, and they kept delaying it, or the project was so promising that all of a sudden there was a landmine they just couldn't have foreseen, and they got stepped on, and it blew the whole thing up. And now they're selling, or they're in financial distress, and now they're either exiting or just giving it away. Yeah. And if you diversify enough and you have that that cash flow coming in, it makes dealing with some deals that have gone bad or not as lucrative, it makes them easier to digest.
Mm-hmm.
Sure.
Mm-hmm.
Yeah.
I think there's a couple of things that come to mind when we talk about this. Number one is, well, my investment criteria is one way, right? And Brian's is a different, Nick's is a third, and some other partners that I do business with, they have their own criteria. The thing that's most important, especially if you're raising money or syndicating, is knowing what your investors are looking for, right? And I think when you start to have conversations with prospective investors, you have to ask them the questions about what kind of minimum investment they'd be comfortable with, what other holdings they have, what are they interested in. People are in different seasons of their life, and some people that are maybe younger or do well in their W-2 maybe don't necessarily need the cash flow. And one of these equity-heavy plays or a development project where they're just banking on a good exit might fit their investment criteria, but you talk to someone later in life that is either retired or on the cusp of retirement, they're going to need that cash flow. So it's really important that you understand the goals and objectives and criteria of your investors.
Yep. Well, if they're high income earners, right? They're probably not as concerned about that monthly or quarterly distribution. They're more looking at, all right, this I need a place to park my money that has hopefully has a great return, and how do I get tax advantages?
Yeah.
And so you're 100% correct, Matt, is understanding the needs of the investor. Because what we want is one thing, but when we go and we put together a potential opportunity for our investors, it's not always what we want, right? Yeah. It's what's best for them. Because ultimately we're going out and saying, hey, invest $100,000, invest $250,000, invest $500,000. And I don't care what you're wanting. This is what works best for us. Right. That doesn't make any sense because we're out there now. We're asking for them to help fund this strategy.
To partner with us. We're becoming partners.
Yes.
So there's got to be mutual alignment there.
Yeah. Yep. And if your partners who are GPing, the general partners of the deal, if maybe they're not in a great financial position, when shit hits the fan, you need to make sure that they're going to show up and not just bury their head in the sand.
Yep.
Right. So ultimately, it's understanding. All right, if this is a long-term equity play, there's going to be ups and downs, and it's a battle and a fight.
Yep.
And 1 minute you're going to feel like you're on top of the world. You're like, man, we got this under control. We just let's fast forward 5 years when we exit from this thing.
Yeah,
and we have this big old check, and everyone's smiling. We're going out to our investor dinner. Coffee's on Brian, and But then the next week, you've got 10 AC units that go out.
Yeah.
Mm-hmm.
And it costs $30,000. And you're like, we're never going to make any money on this. How am I going to send out the investor update and let them know we just dropped $30,000 on
Right.
air conditioning units and it's 170 degrees outside? Like, can't they just fan themselves off? And so ultimately, it's being able to how do you weather the storm and saying, all right, if you're in a whole bunch of if your investment group's in a whole bunch of equity plays, well, hopefully the main partners have the income and have the financial means to be able to see it through over the next 3 to 5 years.
Yeah, 100%, and I think that's part of just doing your due diligence as an investor in the first place is making sure that you're kind of stress testing the deal on your own as well. And I think one of the things that I think it maybe isn't taken into consideration quite as much that really should be as far as GPs and whether they're doing deals where it's offering pref or kind of what it looks like, and then LPs, investors kind of looking to add to their portfolio, is no one has a crystal ball, but you do want to try to forecast what the next, let's say it's a 5-year hold, what do you predict, at least on a common sense level, that your comparative other investments could look like in the next 5 years and what the returns could look like, right? So, for example, it's really easy to say, in 2021 or 2020, post March and April, that you had to have really high cash flowing deals to get deals done because you could put your money in the stock market or treasuries. It was just ripping, dude, right? Yeah. But then you've also got to know that the music's going to stop at some point, right? And so I think that you have to kind of do your due diligence to sort of future cast what comparative investments look like and go, okay, if we've had a 25% run up in the markets this year, is that going to continue next year, or is it time to shift to more equity plays, right? And just not take the past 18 to 24 months as an indication of what's going to happen going forward. You're never going to be able to time the market perfectly, but you can use some common sense on okay, if we've had a great run up on stuff that could cash flow, like equities and things like that, and have a great return on that, maybe it's time to start to shift towards a more long-term strategy.
Yeah.
So I think it's important to do that.
Absolutely. Yeah. Absolutely.
Tax savings, I know we need to get into, or the tax implications are a big part of this, and I know that's way more your department to speak on. Well, what should when we talk about advising LPs or even GPs, right, looking to do deals, how do you, when you're looking to make an investment, how do you factor in, the tax advantages as a variable of the overall investment strategy?
I think it's very scary that you're asking the only college dropout at the table to explain taxes.
Well,
I'll do my best.
Right? Like when you get a degree, there's not a tax course or class.
I don't know. I didn't make it that far, so you tell me. I think one of the best things about real estate is that the mortgage interest is tax deductible, right? And you can either depreciate the property or you can do accelerated depreciation on the property, where you're doing a cost segregation analysis, bringing in one of these big consultants, and they figure out how to accelerate the depreciation on your asset. I think it's down from 27 years to 5 or 7 years. So it's consolidated, but you got to keep buying at that point, or otherwise you're going to outrun your tax bennies, right? I look for, when we're starting to really dial into a deal, I'll get an estimate from our tax consultant our cost seg consultant about how much cost seg we can expect in that deal. And then I try and frame it up for ourselves and our investors that for every X dollars you put in, you're going to get Y dollars of accelerated depreciation that you can write off against future passive income or passive income that you may already have.
Yes.
I think the initial surprise to some investors out there is if you don't have any passive income and you go into this great LP investment and you get cost seg, it may not impact your taxes right away, because if you didn't pay any dividends that year, then you have no passive income to write it off against. Right. So I think that's an important point to know. But the cost segregation and the tax depreciation, or the depreciation and then the mortgage interest being tax deductible makes these things very, 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 very attractive. But it won't save a bad deal.
Well, no.
Right? It won't save a deal that doesn't cash flow well,
or
doesn't have a great return on equity, right? So I think it's kind of the icing on the cake, not the cake itself.
Well, I think that's one. Yeah, deals should never only be a green light because of the tax advantages. That would be a bad deal. But I think that you hit the nail on the head, and something for people to really think about as they're continuing to build their portfolio is like, when you start to build that passive income, it is as important. If you're thinking in terms of cash flow for your entire portfolio, not just for a deal, when you're thinking about your passive income that you're building and then the passive losses that you like to take against it to keep it basically tax-free, if you don't have any passive losses but you have passive income, well, now those are going to be taxed, right? And so when you're starting to weigh the benefits of do I do a deal that might not have a ton of cash flow right now, but it's a great equity play and it's great, total return in the future, maybe I already have a bunch of investments that cash flow, but I don't have any losses right now. And so by doing a deal that is a great return in the future, and I'm going to get some passive losses right now, I've now enhanced the cash flow of my entire portfolio because now I have write-offs. Right now I can take those losses against my current passive income.
Right.
And so that can enhance your cash flow of your entire portfolio. So there's a lot of things like that to start to consider as you're building a portfolio as an investor, that if you're doing all of one type of deal, you're not really maximizing your portfolio because you can work different deals in partnership with one another to maximize your returns.
Sure.
Absolutely. So I think that's a super important thing to consider.
Yeah. I think also it one of the things to consider, I mentioned the season of your life and how that influences your expectation on returns or needed returns. I think it also depends on whether you work or not, right?
Yeah.
Like, since I started my investing journey, I've always had a W-2, and I'm grateful enough to say that that's been a very promising career for me, right? So the immediate cash flow wasn't really a big concern for me, right? The consistent cash flow is helpful, but frankly, I snowball all that, right? Like it's the total compound effect. So I set up designated accounts for all my dividend payments and all my net profit on my units. And then every once in a while, when that snowballed up, I would make another investment, right? Or if I had a great month or a great quarter or a great year, snowball that. And over the course of time, you have 4, 5, 8, 10 investments going at the same time. And it's inevitable that you're going to sell one, you're going to refi one, you're going to get an unsolicited offer on one. The rents are going to go up in a certain zip code, and that one turns into more of a cash cow. So I think the diversification and really laying out a calendar of your returns, your expected returns, is super helpful because it kind of helps you map out the future of your investing journey.
Yeah, I mean, it's unbelievably helpful. You hit the nail on the head. If you're beginning your investment journey. Tony said this kind of last episode. He mentioned kind of, the reality of kind of breaking the golden handcuffs and becoming a full-time investor or living off of that revenue stream. It doesn't happen overnight.
Right.
And the fastest way to get there is to not live off your cash flow or investments. It's to snowball them into building a bigger portfolio. Even if you're looking at cash flow plays, this should always be a long-term strategy. You have hit the nail on the head. You've built cash flow plays in your portfolio that you're not going out and spending that money on dinner. You're snowballing it to grow your portfolio so that whenever the time is right, if you were to choose, you could step away from that W-2 in an easy and healthy fashion because you didn't spend all the money that you had from the cash flow coming in. It's now replaced your W-2 income, and that's the way to do it.
What do you feel as we move forward with, yesterday the Fed raised rates again?
Yep.
Right? So as we're looking at where opportunities where the puck's going, are we going to see that there's potentially better cash flow deals coming on board or equity plays? Because since pre-COVID and now post-COVID, a lot of these deals they had good cash flow, but it was a fast rise in equity, right? The valuations just went insane. So when you look at, when I look at, operators that have sold and they've 3x'd their investors' money, I look at that from was that 2020 to 22?
Right.
Or is that was that 17, 18, and 19? Let me look at where the normal returns would be. And so as we're going into this, rates are continuing to go up. And are we more excited that there's going to be a cash flow play or equity play involved over the next 24 months?
Yeah, I think we're seeing that already. 2.5 years ago, I was seeing a bunch of deals come in that had little to no cash flow. Right, by the time you do your GP/LP splits, I was lucky to find a 3 or 4% cash on cash return deal. But there were a lot of bets on driving value by taking out bridge financing, doing a bunch of improvements, and then doing a refi or exiting at a compressed cap rate.
Right.
Those times have changed and gone away. Right, and I think right now, the sellers that have been successful exiting properties, because there's been a lot out there that just sit, they've come to a certain price realization in their head and gotten comfortable with it, where the team that's taking over that property can cash flow.
Yeah.
Right, and I don't know of any sponsors that have been very successful acquiring deals and or raising money where the cash on cash is even remotely close to the 4% you can go get from a money market at JP Morgan Chase, right?
Correct.
And I think that's really important to note. Like, if you're an LP thinking about getting into a deal, what are the risk factors in that transaction, and do the risk and return factors outweigh the safety of a 4.5% money market account?
Yeah.
Right. Like, frankly, right now, I'm looking for cash flow. I'm okay with a 4 or 5% in year one, or even a 3.5% in year one.
Sure.
If it spikes up in year two once we're done with the turn.
Yep.
But I'm looking for 7+%, high sixes, low sevens, starting in year two and then going up year over year. And I think that's what helps us make more appealing investment decisions for our investors, and frankly, just stay centered.
Yeah.
100%.
And I think, that's a great point. Is you've always got to be weighing the pros and cons as an investor of, what is the easiest way to just keep my money safe and get Benjamin Graham says this in The Intelligent Investor, and I think Security Analysis, his first one, is like an adequate return, right? Like, that guy who's Warren Buffett's mentor built his entire thesis as the most intelligent value investor out there on hitting doubles and singles over and over and over again, right? Adequate returns. Don't lose money, and don't try to get 100% return a year by knocking it out of the park on every growth stock out there, right? And so you do have to weigh the pros and cons as what is the best way to keep your money safe and growing adequately, right? And so, as a cash on cash level, you've got to be able to beat really safe money, right? And I think that where we're headed, though, one of the things that I don't know that we can predict, but I think is a very interesting concept is like, there were a lot of deals that only got done in 2020, 2021, 2022 early on that really only worked at really low interest rates. Right? We talked about this a million times, and this is just all the buzz in the multifamily space right now is what's going to happen with a lot of loans that are either bridge debt or no rate caps or all that type of stuff, right? Are those deals going to blow up? It's also interesting to note that I think for every deal that was initiated at those low interest rates, there was a deal that was done at a higher interest rate 3 years earlier that might have refied at a low interest rate, right? So those could be really great deals right now for people looking to dispo. And does the owner finance model come into play where you can find the arbitrage that really gives you healthy cash flow? Did somebody refi at a 3.5%? They will owner finance it to you at a 5%. right? And now that deal works a whole lot better from a cash flow standpoint. It's a win-win for both the buyer and the seller. That's going to be something interesting to kind of look at as we move through this, this higher rate sort of cycle here.
Well, we're seeing more assumption opportunities.
That as well,
right? Yeah. So I know Deep Blue has analyzed one at an assumption. I know I'm looking at selling a portfolio of mine that the offer is to assume the loan that I have, and the looking at also the equity versus cash flow play. It's also looking in areas that are still continuing to stay strong. Mm-hmm. So like I just pulled this. This is some of the real data from RealPage. And they talk about by the end of 2023, the Dallas-Fort Worth multifamily market is expected to outpace all other markets in the country. And they're also still
in terms of what rent growth? Or
no, in terms of
like units.
Units coming on board, but at the same time, their vacancy rate in Dallas-Fort Worth is only 5%.
Okay, and
then couple that with rental prices are increasing by more than 15% since the beginning of last year. So in certain markets, you're looking at interest rates are going up. Mm-hmm. The economic winds don't feel very good right now.
Feel weird.
Yes, but in good areas, we're still seeing that there's demand. There's not a lot of vacancy. Yep. There's not a lot of delinquency, and that you're seeing rental prices still increasing. So ultimately there's an equity and cash flow positioning plays in certain markets.
Yeah,
100%.
Absolutely,
100%. There's a lot of interesting variables right now. I think whenever you see such a monumentous shift in variables, there's always arbitrage opportunities, right? And this was the fastest rate increase in history.
Yeah.
So that's got to create very interesting dynamics and opportunities.
It's the interest. It's like what we talked about, right? It was the interest rates combined with the property taxes, combined with the insurance, and it was just this trifecta of doom, if you will, and in late Q22 and up the first half of 23. But I think people are starting to become a little bit more accustomed to that. I don't want to say numb to it, but I think, like we just got our property tax appeal. Luckily we won. Thank goodness.
Yeah.
Right? Great job,
Purchase
Luke.
value.
Love you guys. But everybody had this initial shell shock when they got their tax bill in January.
Dude, I almost fled the country.
Yeah. Well,
I was just like,
different episode.
Yeah.
And now a lot of these grievances have been successful, right? Yeah. At least in Texas, right? You're seeing the government and the state government step in and say, what can we do about property taxes? And we'll see what the trickle down of that looks like. Yeah. But there was just this kind of perfect storm of stuff that happened at the same time, really major stuff, and people are just starting to build it into their budgeting and get accustomed to it. So I think that's really important to know. I think longer term, personally, I tend to be the one of the bigger optimists in the group. Is I think we will probably see some stabilization from an interest rate perspective later this year. Maybe one hike, maybe two. I think as soon as they get inflation to 2%, there's going to be a party. And I think a lot of people are going to get more comfortable with the market.
And everyone's going to spend money. Yeah, and it's going to go back up.
We're going to do this all over again.
It might be. But all I know is if you buy good deals now,
yes,
they'll look even better later.
Buy good. That's a really good just investment thesis, right? It's like, how do you just focus on buying good deals when the environment feels like there shouldn't be good deals out there? Because if you can do that, even if you're doing fewer deals, those deals only get better.
Yeah,
over your hold period.
Look, I had an underwriting whirlwind back in May in order to identify some opportunities for 1031, and there's a lot of stuff out there like off market that just doesn't look good, right? And I see a lot of deals coming on the market lately, especially from brokers that I feel a lot more comfortable with, even spending time on underwriting. You know, it takes a couple hours per deal, but when you start to put your data into the model, you start to get an idea probably halfway through whether or not this deal is worth your time finishing and adjudicating and talking to your partners about. So I feel like that the number of those deals is on the rise lately.
I think good brokers, though, right? So you're feeling more comfortable because good brokers won't bring out bad deals or bad opportunities.
Yeah.
And so, I feel that, the brokers that we deal with a lot are, they're not just going to throw, some overpriced, high price. They're not sending us just the overpriced stuff that we know that as soon as we underwrite it, we're just either going to kick it to the curb or just, low, in their terms, lowball the owner.
Yeah. Well, it doesn't work anymore, right? If because that was happening in 2021. Then things dry up and you're not able to sell every piece of crap you throw on the market at whatever price. And so as a broker, it becomes exhausting to do that for a year and not get any deals done. So you start to revert back to the average a little bit and know that you kind of find your space with what you need to go to market with. Otherwise, you're kind of just wasting your time.
Yeah.
It's the same with flippers or wholesalers or anything. I mean, dude, if you were flipping houses in 2021, if you could get something under contract and flip it, it just didn't matter what it looked like. You were making money. Second half of 2022, you were spending a hell of a lot more time making sure you were doing good deals. Otherwise, you were losing money and it wasn't worth your time.
Look, I still flip and dabble here, and I bought one. And it was a good deal just because I bought it for $150,000, and it's hard to buy a house for $150,000.
Yeah.
But it was up way north in a small town, and I tried to sell it I tried to push the value, and I definitely got slapped in the face. For how long I've held it, the return is not a good one.
Really?
A great looking house. It did an awesome job, so I'll pat myself on the back on that one. But
I think that one was on TV.
It was on TV.
Yeah.
Yes,
That's how good it was.
That was on TV. But that was an equity play, and that quickly goes to show you that if you're looking at equity plays and you start counting your eggs before they hatch, I was quickly reminded by the market that that money that I was already depositing into my mind bank, the real bank's not going to see what I just visualized.
Right.
So that if you do too many of those deals, and then you've got some that really slap you in the face because maybe you bought something, you're like, man, I can push rents, I can push this, I can do this, and if you're always having to push to outside or always be the record setter. Then that equity play is not the right deal.
Yeah, dude. I every once in a while I talk to someone who's getting started in investing, right? And they buy that single family, and they lose money on it.
Yeah,
right. They're like, well, the mortgage is $2,400, and I only charge 21 or 22, so I'm losing $200 a month. But it's going to go up, and I'll just make all my money back then, right? I don't know if I don't. Let me say that differently. Those deals do not make sense.
No,
right?
they don't.
Don't lose money
intentionally.
That's silly. Like, what is Warren Buffett's rule? Is don't lose money, and rule 2 is always follow rule number 1. Right? Don't intentionally lose money. You don't need the deal that bad.
Right.
And the compound effect of that $200 a month for however long you hold it, even if you get that money back, it didn't earn you anything.
You're paying for your own anxiety too.
Exactly. Exactly. Right. I one of the things I'm spending a lot of time on lately, and I learned this from Jake and Gino, is looking at a profit per unit metric. Right. So you can talk about cash flow, and you can talk about equity, but what is your profit per unit? And I think those guys are at like $150 or $152 per month per unit in profit.
Wow.
Right. Not NOI, profit.
Yeah.
And that's a great metric to look after. And I think
we should have one of them on the show.
Yeah. We should.
Yeah.
Maybe we will.
Oh, are you winking? If you're listening to the audio version, Matt is winking.
There's a lot of winking
going on. I don't wink loud enough for people to hear me.
Yeah. But that would be really interesting. But no, I love that because I've never heard that before. Right? Yeah. The profit per unit and how to break that down and analyze that and how many units do they have?
I think they're like over 1,500 now.
Yeah.
So 1,500.
I know. I like doing the
don't do the math on don't do the math live, but it's a good number.
1,500 times.
I could tell you it's 225 a
That's
month.
Yearly. Yeah. 228 a month, 2.7 yearly profit in their pockets, and.
It's just a great story, right?
No, it's an awesome story.
It's a great way to look at it.
They built a fantastic portfolio. They made some great decisions on where they were going to do that. Tennessee's done very, very well for them, and they became vertically integrated, right? They built their own property management team, and they've just built one hell of a business. And I think I'll just take it back. Returns aside, returns are important. You're buying and building a business, right? And how effectively you can run that business determines all the other outputs.
Yeah. Couldn't agree more. I couldn't agree more.
Yeah. So, I mean, as we start to wind this show down, right? Because look, there's not a right or wrong. It's just dependent. It's like, in the residential side, when's a good time to buy or sell? You can't answer that question, right? It's whenever it's the right time and makes sense for you. It's the same way of like, should I go for cash flow or for equity? Well, it just depends on your situation. And if you're trying to decide what's best for you, you should definitely get with our partners over at Deep Blue Capital. So go to deepbluere.com, set up a consultation. Matt's the underwriting guru and can really show you what he's done in his projects personally and with his other partners as well, what we're doing here at Deep Blue, and what our other partners like myself and Brian have done, and how there's great cash flow opportunities that they're underwriting. There's great equity plays, and if you're a high income earner, you probably want to look at a combination of a great equity play, because more than likely that's going to have a good tax benefit for you. So go to deepbluere.com. That's deepbluere.com.
All right.
Cool. Good
Boys,
stuff.
Another one in the
Cash
books.
flow and equity. Know the seasons of your life. Talk to your investors about their expected returns. Layer on some cost seg and some depreciation right off that interest, and make it happen.
Make it happen.
I really only want to start breaking out of profit per unit.
I do like that.
We should definitely do that.
PPU.
Yeah.
Yeah.
I like that.
So only coin. What's your profit per unit, sir?
Yeah.
Don't talk to me unless it's more than 152.
That's it.
Yeah. So, all right, guys. Thank you. This was episode 9. Go back and listen to episode 7 with Tony, because actually
episode 8 was Tony. 7 was Sam.
Episode 8. So episode 7 was Sam. But before we leave, I want you to, Brian, you brought up something that Tony had shared in episode 8 about the golden handcuffs.
Yeah, I mean, we touched on this briefly during the show, right? Tony has been really fortunate now to be one of the few, living proof of what real estate investing can do for you as far as replacing your W-2 income and becoming your full-time gig. And when you do it smart and you do it right, and you do it the way that Matt was talking about, snowballing your investments and really building your portfolio, it's more than possible to do. And it's no matter what your income and threshold or financial threshold is, and it is not something that happens overnight. It just is.
How long did it take him, did he say?
7 years.
7
years.
Yeah.
Right?
That's not, that is the 7-year overnight success, right?
Yeah.
It's just the truth. And so I think that what we do really well on this show, and will continue to do really well, is like, this is always going to be an honest assessment of what, real estate investing looks like. And we try to bring as much value as we can. There are very few people that are going to break the golden handcuffs in year 1, but that's just, it shouldn't be your vision, right? Like, you need to set yourself, this is a long-term, lifelong journey, and Tony was just living proof of that, and now he's reaping the benefits.
Absolutely.
Which is huge.
And it's the compound effect, right? Like we talked about before. How many deals did Tony go full cycle on, and how many of his multifamily investments got stabilized and exited before he was able to really go out on his own, right?
Yep.
And those are the things that it's different for everyone. If you have somebody that's working at a fast food restaurant, and all of a sudden they learn to do one flip a quarter.
Yep.
They may be able to exit their W-2 in a year.
Yep.
Right. But you talk to people with, corporate jobs and families and bills and responsibilities, and that number becomes much, much bigger. So it's totally case dependent and individual to everybody.
Yeah, 100%.
Yeah. No, it's a great show today. I love it. We're going for cash flow and equity at Deep Blue. So deepbluere.com.
Love it.
PPU.
All right, boys.
Yeah, PPU.
PPU.
So we'll PPU on episode 10. We'll see you next week. And be sure to leave us a review, subscribe, and share this out.
Thank you, guys.
Thank you.
Thanks,
See you next
everybody.
week.